Everybody's watching the Fed right now, but if you're a real estate investor, you shouldn't just be watching interest rates. You should be watching your lenders. Two banks can give you completely different quotes on the exact same loan on the exact same day, even with the exact same borrower profile. And it has nothing to do with you. It has everything to do with their balance sheet. The truth is, there is no such thing as the interest rate. When people say, "What's the interest rate right now?" That's like asking, "What's the price of a car?" It depends who's selling it, how fast they need to move inventory, and what their cost structure looks like. Yes, the Federal Reserve influences the short end of the yield curve, the overnight rate, the cost banks pay to borrow short term. But the long end of the yield curve, the 10-year and 30-year Treasury yields, drives the mortgage and commercial loan rates you actually see as a borrower. And right now, something very interesting is happening. The short end of the curve is finally coming down, while the long end of the curve is staying higher. That means we're entering a flattening yield curve environment that's starting to normalize. When the short end drops faster than the long end, banks start paying less for their deposits, less for money markets, less for CDs. Their cost of funds goes down, and the banks and credit unions that are deposit heavy are the first ones to feel that shift. These are usually your community banks and your local credit unions. They adjust their loan pricing faster because their funding adjusts faster. They're not relying on Wall Street or wholesale funding. They're relying on grandma's CD and small business checking accounts. This is why one national lender may quote you 7%, while a local credit union quietly drops to 6.4% just to stay competitive. Their deposit costs fell first, so your borrowing costs fall first. That's the power of understanding bank balance sheets. And that's exactly why you need to shop your lender. Every lender has a cost of funds. When short-term rates fall, deposit-heavy institutions feel relief immediately. Their input costs drop. Banks that rely on wholesale borrowings or bond issuances, on the other hand, move slower. They're locked in at higher costs until those liabilities mature. So your rate quote doesn't reflect your credit score as much as you think. It reflects the health of the bank you're talking to. When a bank's net interest margin is under pressure, they tighten underwriting, widen spreads, and quote higher rates. But when funding costs fall and earnings start improving, banks have to lend. They need to put money to work. That's when they start getting aggressive on pricing, and that's when you get better terms. So instead of chasing the lowest rate today, focus on which lenders are structurally positioned to offer the lowest rate tomorrow. So when is the right time to borrow? It's actually in moments like this, when the short end of the yield curve is falling, but the long end is still elevated. That means banks' costs are falling faster than the market's expectations for long-term inflation. Banks get healthier, their margins widen, and suddenly they start competing again. This is the window before optimism returns, when the headlines are still negative, but the underlying financial physics are shifting in your favor. Smart investors borrow into pessimism before spreads tighten. Retail borrowers wait until rates feel low, but when they feel low, you already missed the window. Professionals move when banks' margins begin to heal and lenders become hungry again. Here's how to shop your lender the right way. Step 1. Know your financials cold. Tax returns, rent rolls, P&L statements, personal financial statement. Having everything organized makes lenders fight harder for your business. Step 2. Talk to 3 types of lenders: a national bank, a regional bank, and a local credit union. You will immediately see which one is reacting fastest to shifts in deposit costs. Step 3. Don't just ask for a rate quote. Ask how they are funding loans right now. Deposits and CDs are fast-moving money. Wholesale funding and bond issuances are slow-moving money. This will tell you who is most competitive. Step 4. Negotiate structure, not just the rate. Ask about loan repricing periods, interest-only periods, step-down prepayment penalties, and whether they price loans off SOFR or treasuries. In a declining rate environment, loan structure matters just as much as the rate itself. Step 5. Build relationships. Lenders want repeat borrowers. If you intend to scale your portfolio, tell them. A lender who knows you'll be back will sharpen their pencil for you. Here's a quick example. Let's say you're looking at a $1 million property. At a 7% rate, your annual debt service is roughly $80,000. If rates drop to 6%, your debt service falls to $72,000. That's $8,000 a year saved. But if lender competition increases as margins widen, you may shave off an additional 0.25%, saving another $3,000. That's $11,000 extra NOI. At a 10 times NOI multiple, that's $110,000 in additional property value created through shopping your lender and timing your debt. That's why basis points matter. They translate into equity. They translate into valuation. They translate into wealth. So here's the optimistic takeaway. Don't fear the rate environment. Understand it. When the short end falls and the long end remains steady, it's not a warning sign. It's an opportunity. It means banks' financials are improving. It means capital is about to get cheaper. It means lenders are preparing to compete again. And it means borrowers who are paying attention will get better terms before the rest of the world realizes what's happening. The right time to borrow isn't when rates are low. It's when banks are strong, spreads are wide, and competition is rising. That's when intelligent investors move. If you want help analyzing lenders or structuring your next financing round, reach out to me on Instagram or Facebook. I'll walk you through how to position yourself for the best borrowing opportunities, not because the Fed changed, but because the banks did. Follow the Finance Shark for more real estate finance breakdowns, deal structure strategies, and the psychology behind building generational wealth. The people who understand money don't fear rates. They use them to build empires.